Hi everyone, and welcome to our webinar on how to stress test your business and improve your financial performance. I want to start with a few housekeeping matters. If you go to the control panel on the side, you'll be able to click and download the handouts. As well, through the same forum, you'll be able to send questions if you have any during the course of this webinar. So what we're currently getting, we're just going to get into the presentation here, is mixed signals. What we're seeing is right now, there are some people that say we're in a recession, it's coming closer than you think. There are other things that are indicating their growth, and we're a period of going forward and moving at a higher pace and increasing as an economy. What we'd like to start with is just what is your prognosis for the Canadian economy for 2020? That it remains strong and is growing, softening but stable, noticeable slowing down, or recession is heading our way. If you could take a minute and just indicate what you would select. And we just wanted to get a sense of where people stood at the beginning of the poll, just for seeing how people are going and what it's doing, because we are growing and we are moving forward, but there are some that think a slowdown is taking place. So this is actually a presentation that'll come in handy in either instance. And results show that 78% believe the economy is softening but stable, and 11% believe a recession is heading our way, and 11% believe it remains strong and growing. So in our quick poll, definite winner is softening but stable. Thank you very much for that.
It's pretty consistent with all the news that we're hearing as well too. We're hearing news of sort of conflicting views of what's going to be happening to the economy, so this isn't surprising at all.
I can't move forward. My slide's not moving. Sorry, just a sec here. This slideshow is technical difficulty. Okay, so the benefits of a stress test and looking at it is, it's basically the stress test, and what we're looking at is a financial report card. It's looking at those key performance indicators in your company, examining its performance and making sure, how are you doing? How are you doing with regards to your cash flow and various factors, and lets you know on an annual or periodic basis how you are doing over a period of time on those same set of metrics. And what it helps you do is prepare for an economic slowdown or worse, a slowdown in your industry, or even if you're doing growth within your industry, it can also factor in then. And it helps you ensure that you have improved financial performance even if the economy remains strong. So the benefits to doing this is you're increasing the overall strength and performance within your company and preparing you for anything that comes your way. As we all know, cash is basically the lifeblood of your business. If you don't have cash, you don't have money to pay the bills or to operate, and you're not going to make profit. And cash flow essentially is tracking the sources of uses of the cash that come into your business and are flowing out. In some cases, you may be profitable, but you don't have the money to meet your obligations just because of there's certain investments that you're making or a requirement for cash to be held for a certain period of time, but it's not coming back. Could be in inventory, could be in labor or other costs, depending on your industry. And you can be a growing business. So it's a case of you're making investments for those capital purchases, everything else you're doing. The sales are wonderful, but it's just meeting those bills on a day-to-day basis could cause you concern and start to slow you down. So the consequences of poor cash flow is that you don't have the ability to meet your bills. And currently they're saying about 82% of small businesses experience some difficulty with regards to cash flow. So what we're hoping through the slide presentation, the next few slides, is give you some ideas to address those cash flow concerns or to help mitigate them as time goes forward.
And so it is important whether or not we believe the economy is going to be strengthening, or if it's going to soften and stay stable, or if it's going to be going the other way around and weakening. Really important to actually stress test your business and to see how it has an impact on cash flow. If you do these stress tests and if you are able to make sure that you are properly set up, then whatever happens in the near future, whether it be a strong economy growing or if it's a slowdown, at least you'll be well set up. And so some of the things that we would want to look at within our stress test and some of the key factors would be time to actually collect accounts receivables. So let's say that increases. What sort of an impact is that going to have on your cash? Net sales decrease or gross margins decrease. You're going to want to be making sure that you stay on top of those. inventory turnover. So inventory turnover is basically how many times in a year does your investment in inventory actually turn over towards an actual sale. So again, the lesser that number is, or the fewer times that it turns over, that really relates to more of an investment in that within your inventory that actually is not contributing to your bottom line. There's also available credit decreases. And so as we know, when the economy starts to dip a bit, or if there's any tightening, obviously that's going to affect the available credit that you could potentially even rely on if there is a bit of a downturn or a cash crunch. So some cash flow forecasting tools that are available out there, and this is just a few of many, and you could easily Google for cash flow projectors, but a few that we see would be QuickBooks Cash Flow Projector if you are using a QuickBooks suite. There's also Xero, which is a direct competitor to QuickBooks, which would have its own cash flow projector as well. There's certain commercial banks that offer this. So you're gonna wanna potentially even check with your commercial banker that could offer this sort of software. Some of them have their own for free. And so that could be a good way to even start out as well. And for everybody else that would have Excel, or let's say numbers within their Apple computer, that's also a possibility. So let's say just general spreadsheet software. The issue with spreadsheet software is that you'll have to be comfortable using spreadsheets, but it's cheap since everybody technically or usually has that and would be able to work with them. For purposes of our, I guess, webinar and going through our own tools and sort of examples, we're going to be using Excel, since that seems to be something that everybody would typically have.
I just wanted to chime in with regards to the banks and other forecasts that you see. One of the things going forward and what you're using is just talk to your bankers, because sometimes they don't advertise the tools that they have. Yes. And checking what's available, because a lot of the business banks have internal metrics that they can use, and that they will help even tell you what's happening in your industry. So take a look at that, and if there is information you can use to help you get a sense of how your business is doing, see if those are available for you as well.
So we're going to go into our example. Excellent. All right. So what we did here is we set open I guess a bunch of examples of I guess a balance sheet and income statement of some numbers that you could see within your company, and we just are showing some of the key balances, such as cash between the 2 years, 2018, 2019, accounts receivable, inventory up at the top, and then within the liability section, you're going to see the typical accounts payable listed as AP. We're going to see taxes payable. Working capital is something that you're always going to want to keep an eye on. So working capital is something that is basically your current assets, which would basically be the cash, accounts receivable, inventory in this case, minus your current liabilities, the accounts payable and taxes payable. Another way to look at that is whatever is going to be, let's say, realized or paid within a year is considered as current. So if you look at that and you take current assets minus current liabilities, that's going to be your working capital. So you could see here that between the 2 years, 2018 and 2019, working capital has changed. We're still positive, which says that if there is a crunch and we're able to fully realize or collect on our accounts receivable, and also realize revenues on our inventory, we will have sufficient funds to cover our current obligations. But again, the timing of how that will be realized will also impact that, which we'll go over. And then just at a high level, we've got some income statement figures. We've got sales between the 2 years. We see that going down. Materials or cost of goods sold that we see as well. And then the difference between your sales and your direct costs on those sales is gross profit. Then we've got our overhead, general overhead, which would be, could be rent, could be salaries to office admin staff, it could be marketing. All that would be overhead and fixed costs. And then we've got our net income. So a few of the items that we're going to want to look at would be days in accounts receivable. also known as accounts receivable turnover rate. So this tells you within a year how often you're actually collecting on your, fully collecting on your receivables and how long it's actually taking you. So we like to use days in AR, as most people sort of understand it as that. So basically, how long would an account be an account receivable before you collect? So we see that it's gone up from 25 days, approximately 25 days to 55 days between 2018 and 2019. And that has an impact on cash. And just to let you know, I guess that's gone up about 30 days. So if I say, for example, it happens again, goes up 30 days, that's a negative impact on cash of just over $500,000 in this case. But just to show you, by looking at minor decreases, so let's say even we drop it down 5 days, we improve it by 5 days, it's a cash improvement of almost $90,000. So we can see using these numbers how powerful working on your processes, procedures for your collections can actually do, and the impact that it could actually have on your cash. So it's quite significant. If we bring this down another 5 days, so from 55 to 45, which is about a month and a half, it's $175,000 in available cash. So again, absolutely significant. If we look at bringing this down to what it was before, so collecting within a month, and obviously this would depend on the type of business that you have and you know, and what's sort of acceptable in the market. But looking at that, again, that's a $500,000 increase. So we see how powerful this is. Another tool would be, the other way is looking at this as days in AP, days in accounts payable. So how quick are you actually you know, paying your current obligations, your current payables? And we look at days in AP. So we could see in this example, there was a significant slowdown in paying. So we go from 50 days to 130 days in this example. But you could see the longer that you actually take to pay, and again, this is just looking at it from a strictly impact on cash perspective and not impacting your relationships with your suppliers. But this is just an example to show what impact this has on your cash. So let's say we increase this by 5 days. It's almost $50,000 in cash immediately. So we could see how much of an impact this has. And again, we're just talking about days. If we say this is just one additional day, it's $10,000. So would you want to do this? Not all the time. You don't want to rely on that, but it's one of those things where you're going to want to look at your business and say, okay, so if there is I guess certain stressors in the economy, in the macro economy or the local economy, you know, what tools do I have on hand to help me? And so it's good to understand what they are. Obviously, you're going to want to make sure that you're set up right now with you know, the proper days in AR. You want to obviously bring that down as much as possible. And days in AP, you know, you do want to make sure that you're paying on a timely basis, but you also want to know what's available to you just in case.
And what I was going to put in there, so if you have, let's say, a big check coming or something for accounts receivable that you're anticipating and use to make some payments going forward, one of the ways you can do it, or you have payroll or HST, but you have a temporary cash crunch, just delaying your payables by a couple of days sometimes buys you the time for that check to come in, whether it's just coming in a little bit slower than you were originally anticipating.
Right. And now looking at margins. So I like looking, so this is a very key ratio that we like to look at, because really this is going to you know, tell you the key story, the main story about your profitability, you know, how you're selling your goods or your services, what's that actually costing you, and what's left to actually cover your overhead, right? So if we're looking at margins and we keep an eye on margins, you know, we see in this case it's dipped from about 49% down to 43.5%. But I look at it as, you know, what is every point going to make? So every point meaning percentage. So if we work on a percentage basis, so all of a sudden now, let's say we look at this and we say, okay, so we were able to operate at a much higher margin last year, even if it's a few points higher, we were able to do that. So, you know, what if we were able to increase it by another point? So if we look at another point, this is going to show an additional $62,000 available to cover your overhead. So again, we can see how much a small difference and we won't break the, I guess every business is different. Every business has its own sort of characteristics. Every industry is different, but it's about, okay, what do I have within my cost of sales that can be impacted? Again, keeping in mind, gross margin is a function of also your sales too. So am I priced properly? Maybe you're as low as you can be on the cost side, but am I priced properly? Because obviously, if there's an increase in price, then there would be an increase in your gross margins. So that's one example there. And gross profit. So gross profit here is pretty straightforward. So gross profit is net income percentage over your gross revenues. So we know here any change at all in the gross profit is just going to be a straight addition to your cash. So that's your net income, right? And for your gross profit, that's where we look at the impact of some key overhead items, which we're going to get to later on in this webinar and to look at. But certainly you're going to want to keep an eye on your gross profit and how is that being impacted year to year, and actually not just year to year. We tell all of our clients, if all we're doing is looking at this annually, you could be missing the boat, and that could be significant. So this is something that you should look at regularly, at least on a monthly basis, and depending on your business. For example, if you're into retail or restaurant, you're going to want to look at that even more often. I would say weekly.
And one of the other things to look at it, and another way to word it, is it's kind of like your return on investment. For all the money and time and effort that you've invested, this number is the percentage or the return you're getting on your money. So think of it, when you have an investment, you want to know what you're making on your dollars. This ratio kind of tells you the same thing for your business.
Thank you. And moving on now, so again, we're looking at cash as well too. Cash is king. And so how much of that do I have tied up? How much of that do I have invested in my own business? And this is where we look at inventory turnover ratios and days sales and inventory. So inventory turnover at a high level is basically, how often is my full investment in inventory turning over? Am I realizing sales on that in any given year? And then days sales and inventory is basically, so if I'm investing, $100,000 in this order, how long is that going to be tied up? And because again, you're financing that. So keeping an eye on this is key in knowing how your investments, your internal investments, are being impacted. Is it being tied up longer? If so, what can you do to sort of address that? And again, we're going to be talking about this going forward, but these are some key ratios, again, to know what's happening with your cash. One thing I will say, we are using, as I mentioned before, we are using Excel, and it's not the most user-friendly, but again, we wanted to sort of show what a tool like Excel or numbers can do for you. And this is something that your accountant or bookkeeper or financial advisor should be able to assist you with in terms of at least setting this up for you.
And one of the other things when you're looking at the inventory and the rest of it, one of the key things you'll do, is Chad referred to, it's invested money. It's money not really working for you. So if there's ways you can get a reliable supplier to come and deliver on just in time or just to the site, that alone is going to increase your cash flow tenfold, because you don't have that money invested and not working for you.
Absolutely. All right, so we'll move back out of the Excel. Yeah. When we get that, or as we get that working on, there it is. So what we want to do now is we want to look at, okay, now that we've actually seen the numbers, work for us, and we've worked through what some of the key ratios are, we want to look at, okay, what are some strategies to actually address some of the concerns that you may have. But again, even if there is no immediate concern, what we find to help tremendously for our clients is, even if they're in a position where they feel that they're doing well and they've got a strong cash position, if you make certain smaller tweaks, we've seen with the example, just 1% in gross margin, what that can do to the bottom line, or an additional day in sort of collecting quicker for AR, what that can do to your actual cash. So if you actually work on these strategies and these minor tweaks now, it would help your business be in a much better position to deal with stresses as they arise. So we're going to go over working with clients and suppliers, accounts receivables as well, as we discussed, reviewing your fixed and discretionary costs and what that impact can actually have on your cash flow and your business altogether. Reviewing your cost of goods sold, so strategies for that. Reviewing some key financial ratios as we have, as well as the impact that that would have with your lender relationships and things to consider with that, as well as alternative sources of financing. So I'll pass that over to yourself, Anne.
All right, thank you. Okay, I shouldn't be the one driving here because it seems I'm having the technical difficulty because as we're chanting back and forth, the slides aren't moving. So in our next slide, we're talking about existing, working with clients and suppliers. So the payment terms, deposits, and interest payments. So one of these is looking at what you're saying and how long you're doing. So where possible, trying to get money on the front end. You know, can you get a retainer? Can you get a deposit? Can you get interim payments based on milestones or anything else for your work? You know, depending on the business, the retail operations, obviously, it's when you sell the item, you're going to get paid. But on those other industries where there is a potential spread out over time or payment terms, looking to see that you can get that at a quicker and more efficient basis. You know, and you want to make sure you invoice as soon as you can and more accurately. Now, in some instances, it's the case of people bill at the end of the month. Is there a reason you wait till the end of the month? Or can you bill in the middle of the month and at the end of the month? Can you bill when a project is finished? So looking at the best ways to bill and billing it as soon as you can so that it starts the clocks, you get the money in sooner rather than waiting till the end of the month, which traditionally has been what normally takes place in a business, just changing the cycle a bit, shaking it up so that you're doing it on a, as soon as you're done the work and on a quicker basis. Maybe it's a case of when you're working with some clients, you're always chasing them. It's hard to get paid. You get paid at the end, but for all the time and effort and money that's adding to your bottom line, you know, do you continue to work with them? Sometimes it's turning down work when necessary because you want to make sure that one of the things that's important as well is A, you're getting paid, but also if there's a limited resource in what you're working with, pick up the work with the better margin, pick up the quality work. Don't necessarily just accept everything because it comes through the door. Make sure that what you're doing makes sense with your business decisions and going forward. Another thing is don't be afraid to do a credit check. You know, check and make sure that, okay, you're lending credit to these people. You're doing work. You're spending time, material, resources, and everything in what you're doing. Make sure you're going to get paid at the end. And if it's someone that's new and a policy, maybe you want to put it in place, is get a retainer for the first year. And then once you have the relationship and you know you're going to get paid and you have that history and you get to know each other, maybe it's a case of move forward and then you're just billing as you're going. And also focus on the specifics or the scope of the work at the outset. Because you've made an agreement, you know what you're going to get paid for. Depending on the industry, careful about going too much outside the scope, because if you do too much work and it's not what's agreed upon, are you going to get paid for the work you do? So making sure that at the end of the day, the AR, the invoice that you issue is valid and you're going to get paid on the work you've done. Chad, did you have anything to add?
Yeah, if you're looking to sell abroad, if you're exporting, one of the things that you're going to want to consider is at least looking into EDC and potentially having those sales insured. So it's another avenue of you know, trying to minimize that risk of selling abroad and not getting paid. So sort of falls into in line with, you know, potentially doing a credit check, but again, looking at insurance for that.
All right, thank you, Chad. Suppliers, so on the accounts payable side, what can you do to help with your cash flow on that basis? So sometimes it's a case of suppliers will offer you discounts if you pay early. Sometimes it's a case of doing a bulk order or committing to order a certain amount of goods with them so that they will give you the better credit terms or the better terms of payment. So having the discussion. Also seeing what payment options they might be willing to provide. Maybe it's a case of if you, similar to what you're asking, you provide a slight retainer up front, maybe they'll offer you a discount because they now have cash in their bank account, which helps their cash flow, so they're possibly willing to discount what they're charging you and what you're buying on a go-forward basis. As we already alluded to, review the inventory and your need for having it on hand. Do you really need to have it? Is it affecting your business if it's not on site when a customer orders? Or is it a case of, can you have it delivered to someone with a 24-hour just-in-time turnaround? Taking a look to see that having the inventory and how you have it set up, it's efficient and it makes sense, is a good way to free up cash. And then also look at consignment sales. So look at, maybe it's a case of, okay, when you bring the goods in, maybe it's a case of you just pay when you get paid. You're not actually paying for it when it comes onto your site. So consider doing consignment sales for some of your suppliers and see if they're willing to undergo that arrangement. And then within the accounts receivable, as I already alluded to some of the things to consider when you're looking at accounts receivable and trying to get that money in early. Because what we're looking at, and one of the keys we're looking at, is getting that cash flow as soon as you can. And that's where incentives for early payment or discount for paying us on time and as soon as we can. Retainer agreements, as already alluded, so when someone's new or when you're starting a contract, and this way too, as part of the contract, receiving the payment, you're agreeing to the terms, they're agreeing to what it is, and they're kind of acknowledging that, okay, here's our down payment towards this product you're doing for us. Discounts for the partial payments, so that's again a case of where you pay over time, maybe with milestones based on a time frame or when the various times are, but just not doing it all at the end, so getting payments or a series. Customers or clients often say it's a case of, okay, we're going to charge interest on overdue accounts. In a lot of cases, what sometimes happens is the business is just happy to get payment at the end of the day. They've been cash flowing it. They've been carrying the cash for a while, but when it comes to it, they may incorporate the interest charges, but they're not always proactive about following through on it. So just a case of look at it. And if you are paying interest because you're carrying a customer's accounts, revisit if you should be charging them interest. And as I said earlier, even go back to if they're doing this on a consistent basis, are they really somebody we want as your client?
Yeah,
is it sometimes to cut the ties?
Yeah, it's interesting because people don't generally look at it that way. With that, you're actually financing your client's business, right? So when you're doing that, when you've got accounts on receivable, that's what you're doing. You're financing that part of the business for them, right? And so there certainly is a cost for you to doing so, and we saw how much of an impact that could have on your cash. But you have to sort of look at it that way and make sure that you're staying on top of that.
And the other thing is just staying on top of accounts, because there's often what you hear within a business is that, through an invoice going awry, whether it be through email or paper, sometimes invoices do get awry, they don't get in the system, and just staying on account and reaching out and not being afraid to have that outreach and say, look, we sent you the invoice, we haven't got paid on it. And part of that is maybe establishing a more formal process that once a receivable reaches a certain time frame, have it go automatic, have it say, okay, the reminder email for the invoice, or what's an accounts receivable, and say, okay, pay us now, or maybe we're going to charge interest. Chad, did you have something you wanted to add?
Yeah, it's this is one of those things. Let's face it. I don't think anybody enjoys this part of their business. They get into business for what they do, for the services that they provide, for the goods that they sell. They don't necessarily get into business to deal with this part of it. Yeah. Yet it's so key, and because of that, people aren't necessarily good at this. And so how do you try to avoid this better? By having set policies and procedures in place. And as Anne was saying, maybe it is setting a policy of retainer agreements or getting paid up front, depending on again the service, or any one of these sort of strategies. Having that in place and following it so that we can avoid having to follow up with them regularly and dealing with incorporating interest charges. I'm sure nobody really wants to do that. So it's such a key part of your business, but nobody really wants to work in this area. So again, let's set something up so that we don't necessarily have to all the time.
Another key thing to build in here as well with the follow-up is that this way, if you're following up and you're not getting payment, it might identify earlier someone else who is in difficulty, and rather than keeping to extend credit because, oh, they might be late, but they'll always pay us, you're not continuing with that assumption and continuing to let them sell them more product or do more work for them, and that at the end of the day not get paid for it.
Yeah.
And that's one of the real benefits to staying on top of the accounts, is hopefully identifying early those that are a potential risk of you not getting paid, because you're able to see what's going on with their business and having the conversations on an earlier time frame.
Yeah, good point. We've seen a significant drop in the probability of actually collecting on accounts as soon as it hits 150 days old, and past that, again, the probability of collecting is significantly decreased.
All right, Chad, I think this is you.
Of course, yeah. So reviewing your fixed costs and discretionary costs as well. So this is pretty key. So this is again going back to that overhead. And so what we found with even if you think back pre-2008, because I've noticed this in let's say with our clients and with many other businesses, pre-2008, I think people were a lot more comfortable with spending on meals and entertainment, for example, promotions, marketing spending. And then all of a sudden 2008 happens and everybody's looking to cut back everywhere. And again, not saying not to that you shouldn't be investing in those areas. But again, looking at your current business, how you're spending, where you should be spending, doing it now before a 2008 happens again. Hopefully that never happens, but before another recession occurs could really help you. And so people get comfortable with a certain way of business. And again, on the slide we're saying can quietly increase when business is growing and profits are high, and then all of a sudden you get hit and realize that you've been sort of letting go a lot of your hard-earned cash. So you're going to want to stay on top of this. Overhead costs can truly eat away at the bottom line, and I'm going to want to show you an example of that. But basically, small savings in costs can have a tremendous impact on finances, and you want to look at it at a line-by-line basis. Really, you want to look at it by how much are you spending on. We talked about advertising, promotions, but also, how much you're spending on, on, let's say, leasing of printers, of, stationery. You basically want to look at it on a line-by-line basis, telephone costs, and look at what other options that you have available. So just to give you an example of how important this is, we've got a calculation here. So if we look at this typically, and just to use simple numbers, we've got revenues of $1 million. We've got cost of sales at about 40%, which is typical for many different types of businesses. So you've got $400,000, so gross profit of $600,000, and overhead of about $450,000, giving you a net income of $150,000, which is about 15% of your gross. So we're using 15% because that's what we typically see in and around that you basically net about 15% of your overall gross revenues. Again, this is just an overall example and not indicative of every single industry, but pretty close. And so what does a savings of $25,000 in overhead actually mean? So this is what we like to sort of break down with our clients, for example, is $25,000 in overhead savings actually is equivalent to sales required of about $167,000. So how do we come to that? So basically, if you're working at about a 15% net income basis to gross, $25,000, you sort of look at that and say, okay, so for me to actually end up with $25,000 in net income, what would I have to sell to be able to actually enjoy that? And so when you look at that as business owners, you realize that sales comes with risks, comes with effort, comes with a whole bunch of things with respect to actually staying on top of it, selling, closing and administrative sort of time with that. So a $25,000 decrease in overhead really goes a long way if you equate that to what you're actually selling and what that would be in terms of trying to come up with that same savings or same bottom line.
All right, that sounds good.
And so again, going into this, what you'd want to do is you'd want to renegotiate. So renegotiate with your supplier contracts. You want to look at your rent. Rent typically tends to be one of the largest overhead items. So you want to look at rent. Are you paying market rent? Maybe you have, or you had certain aspirations initially of having a certain size of staff, but haven't gotten there, haven't reached it, or have come up with different ways where maybe through automation that you don't actually need all that real estate. So look at that. Are you paying for more square footage than you need? Are there other options such as potentially subleasing, or again negotiating with your landlord? Looking at your staff. So can staff numbers actually be reduced? What's key is obviously without sacrificing quality and production, obviously, to meet your demand. But again, are there ways for you to be able to automate, for example? So you're going to want to look at that. Operating costs themselves, eliminating spending that doesn't actually contribute to production and sales. So what we mean by that is again looking at what and you want to look at it as in terms of investments in the business. So if you're going to be investing your hard-earned cash in your business, what is it actually benefiting you? And having that sort of test, that question for any key spending is, what is this doing for my business? Is this necessary? How is this going to help me? Is this strategic?
And sometimes it's a case of when you look at it and when you're factoring that in, sometimes employees are a key resource in the industry. So there's cost with regards to employees, and there's meals and entertainment, promotion, you know, Christmas party and everything else, but just doing what makes sense. There's being the Cadillac version, and there's being the version that you can bear with your costs, depending on where you are and what your company's in play. And the other thing to keep in mind when you're looking at staff numbers and what it is you think back in the past when we used to have monthly invoices, manual, and everything was being sent out at the end of the month. Now we've gone where people pay online with Visa, they can do it right at the point of contact. There's a big difference in the manpower required. So sometimes it's even looking at where you can get efficiencies. It's not necessarily reducing the staff size, and maybe it is, but it's looking how to can do stuff more efficiently so you get a better result at the bottom line.
Right. And again, it's focusing on the ROI or return on investment from your marketing spend. So not necessarily that you're spending less, but if you're going to be spending, what are you getting from it? You know, we notice this a lot with clients is there's a certain amount of spending being done just because that's what, you know, has been done in the past. For example, you know, could be, you know, a suite at, you know, let's say, you know, for watching the Ottawa Senators, or, you know, it could be a number of different things that, you know, you have it just to have it, but are there different ways of doing that? So again, it doesn't necessarily mean a reduction in your marketing spend, but it's looking at and understanding what that investment is bringing to your bottom line, and looking at ways of tracking that. I think that's really important. Again, we see what a small percentage or a small dollar change in your overhead can mean in terms of, you know, the equivalent sales needed to get there. And, you know, again, looking at alternative ways of doing business. So an example that we have here is, you know, video conferencing instead of traveling, you know, and, you know, so again, using that to your discretion. You know, being a meeting in person is obviously pretty key, but, you know, can you be looking at different ways of doing that? And, you know, maybe video conferencing and not necessarily having to travel is going to allow you, or should allow you, to be potentially even more efficient. And so those are some of the examples of looking at your key discretionary costs.
And one of the things, even when you look at the video conferencing versus travel, there's also the side benefit. You're not losing all that travel time. Besides the expense and what underweighs,
Exactly.
You're also gaining back the people hours that take to get to that location.
Exactly.
Especially if it's out of town or the rest of it.
Right. So again, now we reviewed overhead. We want to look at as well the cost of goods sold. So as I mentioned previously, you know, so cost of goods sold are direct costs to actually selling a product. So it could be, for example, if you're selling a product, you know, what it costs to actually have you purchase that product. If you're selling a service, you know, what are the direct costs associated with you providing that service? For example, it could be salaries directly relating to that. But as I mentioned, you know, cost is only one part of that overall ratio of that equation. You may want to look at your pricing model. You know, so as you review your direct costs, again, look at your pricing model and try to figure out, is this something that, you know, obviously this is going to require you having a good sense of your industry and your client base and what's sort of acceptable. But, you know, should you be looking at increasing that those sales? Because I think, you know, a lot of people just concentrate on the cost themselves, but again, there's two parts and two sides to that equation.
So one of the recent things we've seen, and we've seen in some clients as well, is where it's been historical. Okay, the prices have remained steady in what they're charging the clients, but they've seen a real increase in what their costs are, whether it be from the materials or for the staff that are doing the work. And so they're hesitant to raise prices. But the thing you have to bear in mind is that the industry changes. And as the cost increase, to make sure that you continue profitable and viable, you have to take a serious look at repricing what you're selling to your clients as well, or you're not going to be around for the long run.
Right, and this is another area where you may want to look at automation. You know, what's available out there for your industry, because again, if you get to a point where you don't really have much leeway for pricing, it's let's say it's the industry is very competitive and sensitivities to price increases are high, then again, part of reviewing your costs is also reviewing your procedures, your processes. You know, could you cut out some of the fat, so to speak, of you delivering that service? And you know, sometimes automation can be an alternative there.
And embracing technology and anything else it brings to it. So there's the processes, but anything else within the office, even if it's within administration or invoicing to the clients or getting paid, any technology that you can introduce to getting that cash in your bank account quicker is important technology as well.
Right. then leasing instead of purchasing. So, looking at, instead of going into a major equipment purchase, maybe you're leasing it instead. And there could be some tax benefits to that as well that you should sort of speak with your accountant on. But that could be an alternative, as well as looking at secondhand equipment, again, depending on your industry. Another area, or another thing that some of our clients do is, and they've been quite successful at looking for opportunities to purchase equipment from bankruptcies in their industry. And so one of those things that you're going to want to do is potentially even contact some of the bankruptcy trustees in your area and just letting them know that you would be interested in hearing about equipment or other items that may be available within a specific industry. And looking at, we talked about production process improvement. So those, again, are key. So looking at that, reviewing it, seeing if are there any redundancies, but each one of these steps usually requires resources.
Or even taking a relook at how you do stuff, looking at your process improvements. Because what we seem to find in some businesses is that they continue over time, they take whatever their current process was, adapting new technology, but don't really look at the whole process and say, okay, what we're doing overall, does it make sense? Or should we basically streamline this process from beginning to end?
Right.
So the next thing we're going to talk about is the key ratios and lender relationships. So one of the biggest thing when you're looking at it is the fact that you have a relationship with your lender. They have certain things they want to achieve to make sure you're a viable company and you're going to continue to operate and basically be able to repay them. And one of the key things is that, so when your business is doing well and it's very strong, I know you don't necessarily need the credit, but it's the perfect time to go out and negotiate that additional line of credit. Because often, if there is a time when you do need the money, it's not something they can turn around on a dime. It takes time to establish. And when you have the time to sit and negotiate and get the favorable terms because your results and your company is doing well, that's the best time to do it. So renegotiate, look at additional credit, lines of credit, establishing a loan maybe for an equipment purchases when your finances are very strong. And when you have the time to pay it the appropriate attention, not when you're trying for a quick turnaround. The other thing is when you're looking at the banking agreements, look at the banking covenants that you're required for financing, the working capital ratio. Even make sure that the ratios make sense within your industry. Because sometimes the failure to maintain the ratios can result in the loan being lost and you don't have the credit. Now, one thing to bear in mind with here is, okay, sometimes there's a case of you have a temporary blip, or maybe you don't meet the ratios. So what we often find is if this does happen with a client, we will actually outreach to the bank and have a conversation with them and say, okay, we know we're offside at this point in time. Here's ABC, how it corrects itself. It's a temporary blip, so that when we're doing those insurance engagements, we're actually able to say on the statements that, yes, the covenants were broke, but the lender has indicated that, there's no effect from it. So there's the strength, and there's the strength that goes with relationships and having that discussion up front and ensuring and talking with the lender and working with them as your business partner, because they're in there with you on this, on your operations, and hoping you succeed. And the other thing to look at is there's a lot of alternate sources of financing, other ways you can get your money that are out there. And some of it is a case of, yes, there's additional, okay, the company needs money. What personal assets does the owner have? And you basically show them as credit, or you basically put them on the line against it. The second one we have here is factoring, where that mainly comes into play with your accounts receivable. So you need the cash now, but your clients are going to take longer to pay. So what you can do is go to a company and get paid part of the money on your accounts receivable. You're getting it sooner, you're not having to borrow on it, but unfortunately you're not getting the full amount because the company that's collecting for you is going to keep their share of it. The invoice financing, so we're just essentially looking at the interest rates with what it is and trying to get the amounts when they pay, take a period of time to pay.
Yeah, for the invoice financing, I find that works well or better when you actually have invoices or accounts receivable, let's say out to, let's say, the federal government, for example. So the federal government, if you're pretty confident that they're going to pay you and they're great at doing it, they just take a bit longer to do so. This is where it tends to work even better.
All right. And sometimes even using non-cash assets as collateral. This can be a case if you have a piece of real estate, if you have inventory, there's other assets, and what they'll just ask is that it's there to support. Banks normally will already have a general security agreement. And if you are buying a piece of capital equipment or something that is tangible in nature, you can often get financing with that piece of equipment as security. But sometimes it's a case of you're lending for a specific purpose, whether it be operational or payroll or expansion. In that case, the non-cash items are very helpful in getting the collateral on a go-forward basis. As Chad already alluded to, ensuring the foreign accounts with EDC when you're selling to foreign clients to ensure that the money's coming in, and that way there's less concerns about not getting paid. Another thing is with regards to, we talked about leasing equipment and we talked about loaning for capital, but another thing that banks offer and other companies will offer is essentially you can have finance terms or a lease with an asset as you go to buy it. But there are also companies that will essentially take an asset that you already own, they will buy it from you, and then they will turn around and lease it back. And so what's that doing? It's giving you that temporary cash injection, and then essentially you're paying it down back over time. So it's a non-traditional way of financing, but it's just looking at another way to possibly get money into your business now with assets that you already own.
Right, and you're certainly going to want to make sure that you speak with your accountant before doing this, because there could be some tax implications to doing so. So, you want to be strategic in terms of what asset you use to do that.
Yeah, so one of those, if it's hidden, like if you've had a long time, you don't want to create a big taxable gain just to get cash in temporarily, right, where the tax you pay is going to offset any of the benefits you received.
Yes.
The last source of funds is friends and family and someone looking to invest on, and these are generally on a temporary basis to come in the business and help out with that temporary cash flow glitch and not being able to service the cash that you have.
Could be the most expensive form of financing.
Yeah, it's relationships and everything else, and they must be the most concerned over what, right, you're doing and how you're doing it, and want to provide for their money some advice on how you should run the business.
Right.
And at the end of that, that's kind of our set slides and content that we have. At this point, we'd like to open the floor for questions and answer any that we've received during the presentation.
We have a question that's just come in about cash flow. How do I go about starting the process, and how often should I be reviewing cash flow projections?
Yeah, so starting the process of cash flow. So how would you go about doing it? I would think that the best way to start that, number one, is having that conversation with your accountant. You want to look at what are the key triggers to cash flow in your business. So number one, you want to look at what are the uses of cash, right? And that could be, again, investments in AR, because that is an investment, in inventory as well. And then you also want to look at, on the other side as well too, you're paying payments towards, accounts payable, towards loans or whatever. But then also looking at your production, your profitability. So how you'd start out would be, certainly I would say, sitting down with your accountant, looking at that. Every business is a bit different. When you have what we tend to do is do a cash flow statement. It sort of breaks out the different areas of cash, and it helps you to sort of zero in on what some of those are. But really it's getting that sense, and then looking at some of the key ratios that we talked about, because at the end of the day, they're going to be key performance indicators, right? So that's when you realize, or that's when you can sort of look at it and say, okay, so where can we actually dive in? Is it, are we taking too long to collect? Our procedures for delivering these services, but it would start with your accountant.
And the thing I want to add to that is, one of the things too is knowing and understanding your business cycle, because there are cyclical businesses where there's more of a cash requirement, right, at certain points in the year. So part is understanding the timing and the flow of money, because it might not be a case of, okay, I need money now, but getting a good understanding of, and that's one of the things with different points and checking over time, is that you'll get to understand the business cycles, get to understand what's at play. So that even allows you a bit more to look forward, look to see what your temporary needs are. So if there is, jobs are slowing down and you don't necessarily know what your next job is, even with regards to if there are temporary needs because you're in a growth phase, getting a better sense of, okay, here's the needs I've traditionally seen, and then taking a step forward to say, okay, if this happens, or I go into this new project, how is my cash needs going to change? What do I need to adopt to make sure I meet those needs? Right,
and it's amazing if you get in the habit of doing this, and then tracking it again. Let's say if we say on at least a month-to-month basis, the understanding that you'll end up having of your own operations and profitability and impact, and then it lets you have a better sense of what your cash position may look like in a month from now, and then trying to plan accordingly there. But when you start that process, it's a big process, but once you have that in play, it's a lot easier to sort of stay on top of that. And again, the insights that you'll get from that can be tremendous.
We have another question. What should I do if I don't have the expertise in-house to manage projections?
So one of the key things is that looking to make sure when it comes to your financial statements, you always understand what's taking place in your business. And there are a lot of businesses out there where they will have a person who essentially does the invoicing, makes the bank deposits, issues the accounts receivable, but they're not knowledgeable or skilled enough to do that long-term projection, to take that look out to see where things are going. That's where talking to your advisors can help you. So talking with your accountant, your investment advisor, other professionals that are part of your team, and saying, okay, this is what I want to do. And even in some cases having a set up, let's say, quarterly meeting to say what's coming up, what's going forward. So having that conversation so that when you make those business decisions, you're kind of aware of based on what you're doing and where you intend on going, what things you need to consider so that you make sure you're making an informed decision when you do make the decision and moving forward. And let's say a project, taking on a client, or anything that's really outside of the day-to-day that you're normally doing. You know, your advisors are there, they're your team, they know you best. Don't be afraid to ask them questions because they can help you provide very key advice.
Absolutely, I would certainly emphasize that as well, right? Because again, people are good at doing what they do, at the services that they provide or the goods that they sell. They're not necessarily financial people or accountants that'll sort of dive into this. So it's key that you do get this in place. I would say, again, starting with your accountant, but also what we like to do with a number of our clients as well, depending on the situation, is including some of their key advisors at the same time. That could help. But again, your input would be absolutely key because the numbers can only tell a certain part of the story, whereas you would understand the operations and why certain things are the way they are and what the limitations are for certain things. So if we say, for example, well, can you increase the price? You would have a much better sense of what the sensitivity would be in your industry. So it's basically a team approach. But again, it goes a long way. And as Anne was saying, we like to do that on a quarterly basis for a number of people. But with the fact or the understanding that you would then have the tool to maybe look at it on a more frequent basis. But again, for others, we look at it on a monthly basis. But again, you're going to want to understand what those flows are and those differences are as you go.
And one of the key things to tie in there is just making sure that you have the conversation that you're not just looking back at your past financial information because it's historical. It's not going to help you drive it. So if you wait till your statements are done and then it's 12 months, there's the year end, or 3 months after that, you're having a hard time turn around or being proactive to any changes you see in your industry. Right. So having those touch points or looking at those metrics on a regular basis ensures that you're looking at stuff on a timely basis and able to make decisions that are going to affect your bottom line as soon as possible.
Thank you, Anne. And Chad, we have one last question. If cash flow projections are poor, are there steps I can take to limit personal liability?
Yes, yeah. So, and this is one of those things. That's a great question because it leads to what we were saying before about, let's not wait until cash flow is poor. What can we do right now to have a setup for, again, stress testing our business. So in case there are stresses out there in the marketplace in our industry. So what we like to do is we always like to look at, what assets are in anybody's personal names or in the actual business. And so, for example, do you, as a business owner, do you have your personal residence in your name? Can it not be in your spouse's name? And actually, before going into this, I should mention that we're not providing any legal advice. So certainly you're going to want to speak with your lawyer, especially when it comes to potential family law concerns. But are there certain things that you could sort of move to your spouse's name? If we look at your business itself, and your business is holding excess cash to the point where it could just be in your cash account, or it could be invested, let's say in a GIC even within your business. Should it be there? You really need to understand and realize that your business is an operating business that has inherent risk and liability associated with it. So just by having it in the corporation, it's open to those creditors. So we like to look at ways, obviously, in a global scale when we're looking at overall tax planning, estate planning, but also asset protection planning, and can we move those funds and those assets out and have it protected. Obviously, not protected from the banks. We want to make sure that the banks have and are aware of where those assets are and have the right collateral, not from CRA, but unknown risks and liabilities. Even something as simple as, if you have some key equipment, or let's say real estate in the same business or the same sort of corporation that's operating that business, that's really out there for risk. So can we not move those key and valuable pieces of equipment and that real estate out to another corporation, and maybe have some sort of a chargeback, a lease, or usage fee between the two. So there are a number of things that you're going to want to look at. And if you're waiting for the tough days to sort of come, that may or may not be too late. So obviously it's one of those things that you're going to want to make sure to stress test now and consider now.
And just to add to that, so one of the things that you want to summarize what Chad was saying is that you worked hard for the money that and the profit you've earned in your company. Just looking at ways to mitigate in case the unexpected and the unforeseen happens, you want to make sure you're keeping as much money in your pocket as you can, based on the fact you don't know what the future holds.
Absolutely.
And
all right. Well, we thank you all for logging in and viewing our webinar, and look forward to holding another one in the future.
And if you have any questions, you can see our contact information on the bottom. Please feel free to reach out and we'll be happy to answer any questions.
Thank you.
I'm waiting for him to say